The following is a presentation of TFNN. The Tiger Technician Hour with your host, Basil Chapman. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, Basil Chapman.
Hi everyone, Basil Chapman, Tiger Technicians Hour. My pleasure to be here Monday through Friday, market days, and we're looking at a Dow that's at down 252 at 16,256. The S&P is down 30 at 1936. The comp index is down 86 at 4742. Gold. Now you'd think that gold would be higher. It's down 8. It should really be about 12 points higher because if the XLF, and I kind of relate the two in many ways. XLF is down 37 cents, 22.56, down 1.59%, exactly the same as the S&P. My thinking here is that something's going on, that gold, I mean, if this is a deflationary era, and that's what the market's really anticipating and is upset about, look at the way this 200-period moving average in the 120-minute chart from that peak F top in the gold 120-minute contract has held. This is going to be very important. 122's support is at 123. If that breaks, then the next support goes right back to where it was on the 17th at 1114. I would say that the whole 1114 to 1110 area is really critical in gold, because in this phase, if it's only bonds that are seeing the safety, money flowing into the so-called safety of bonds, that in a way says something a little different is going on. So let's just go through the numbers. So you've got gold down, you've got the silver down 44 cents at 14.78. You remember yesterday, the silver was holding a little better than gold. And now look at this. This is going to be very interesting. Why? Because you got the dollar screaming to the upside. It broke that. It absolutely broke the that red line that I drew in as a critical support level to pierce, because what have you got? You've got Chapman wave. Now, first of all, let me just go back here, because I mean to spend one of the Fridays on this, because that's Technical Friday. There's a pattern that I've been discussing for months. Well, I'd say July. Yeah, it's months. Couple of months. And that was the Chapman wave unconventional flat base restart. I remember talking about it sometime mid-July, and I said, gee, if I'm correct here, there's something going on that says, and I typed it in, Chapman wave unconventional flat base restart. We had a left side, right side price time action. What I said is, it's a very strange pattern. If you're able to visually identify it, it tells you that if you want to look at a chart formation that has tremendous whipsaw ability, this is the one, the Chapman wave flat base. It's the unconventional flat base restart. Let me just quickly enumerate the details. Basically, what you see is that after peak D, you do get, within 3 bars, you get that extra leg that says it could be an E and it could be an A. So it's an alternate wave count, and you always be conservative. You call it E first, A second. And then it invariably goes to something that looks like a top, and that top could be at the B or the C, which is either F or G. For those of you who do Chapman wave analysis, you know that what I'm talking about is just a real simple concept. The words make it sound very convoluted, but it's real simple. And basically what you had is you went to 98.15 on the July the 20th, pulls back very sharply. That's the characteristic of the Chapman wave unconventional flat base restart. It's also the pattern for the flat base restart. The unconventional flat base restart says that you've gone a little bit deeper than you normally would go for one of the pullbacks, and that was the pullback after that E/A, and it went to 95.45. And what I said is, regardless of how high the dollar goes, at some point you'll get a leg D or E. It's something that you visually identify with, because the stochastic and the MACD do not confirm the top. And then what it does is it pulls back, looks like it's going to once again go close to the basic support line, and then rally, which it does. It goes right to there, I'm making it dark so you can see, to 95.93 on the 12th of August. It bounces up, hits the 9-period moving average, that black line, gets repelled, makes the H pattern that I always talk about, the lowercase h, and plummets through 95.45. Just like the Chapman wave stalk leg formation, we haven't seen too many of those lately. Once you complete the move, the beak, in this case, that sharp move down, essentially starts a brand new buy signal. But that buy signal says you can go back to where you were, but then you're on your own. That's all. It means that to complete the entire Chapman wave unconventional flat base restart, you break the previous low bar of importance, that's 95.45. And then when you get a turn to the upside, it's a turn of significance in time. It doesn't say that you're going to go to an A, to a B, to a C, and a D, peak D. It just says, I'm going to get you out of this. I'm going to get you back towards where you came from. That's 95.45. And then you're on your own. You've got to use other techniques. Well, the other techniques we used, we were looking at it the other day. I said that trend line that's red, I'm especially making it red, that red trend line that we've hit so many times exactly. And then I love the way trend lines identify exact hits. You couldn't pre-plan something as perfectly as the way nature or the market nature does it. And then what does it do? It pulls back, makes the arch formation, holds the 200-period exponential moving average right there, the coral-colored line at 95.28. And what does it do? It spikes up for 2 days, and it takes out decisively what was a very strong repellent line. That becomes a support line. Any pullback in the dollar in the next few days has to hold 95.40. But if it takes out the left side high of 96.62, which now let me go to the arch formation. Remember, the market is made up of only 3 patterns: straight up, straight down, arch, or cup. And the arch and cup have variations, a V or an inverted V. But basically, it's just the same thing. 3 patterns. What are we looking at now? We're looking at the left side high bar in the dollar. And why am I spending time on the dollar? Because the dollar, I think that the Fed was desperately trying to get the dollar to rally. No, I'm sorry, the dollar to decline. They weren't really looking at bonds so much. They weren't caring so much about interest rates. They really wanted to see what they could do with it. This is my guess. How are you ever going to know? But that's my thinking. Why? Because if the dollar can be pulling back sharply, all of a sudden, the benefit will accrue to the multinationals, which are being decimated, especially the cyclicals like the GE, AAM, IBM, UTX. Okay. If the dollar decisively closes above 96.62, that's really important. Not only is it leg C in the daily, A, B, C, D. This is leg D in the 120-minute chart. Let's just get rid of that for a moment. What happens is it can head towards the next dash trend line. I should make that thick red, but it's getting too messy as it is. Remember, cup formation, arch formation, arch formation, arch formation, cup formation. That's what we're in. But the MACD and stochastic in the dollar, the weekly chart, this is really, it's quite something, because the dollar is being moved by huge factors. It isn't the technicals per se. I think it's buying from internationals because it's the currency of choice. I just make it as simple as possible. I think it's a currency of choice at this particular time. And that says that the dollar, still on a technical basis, is only consolidating in the monthly chart, but that weekly chart is making that soft W formation, U and another U, and it's got that trend line that has to be pierced. And in this case, it's far more significant because the dollar has to climb all the way to about the 97.90s. It really should take out the high of 98.33 that was made the week of the 7th of August. And then all of a sudden, you've got a trend line that I can start to point to. I don't want to make it messy, but let me just do this. I want to show you. That would be the trend line, and that would be the trend line right there. And that trend line would say that the dollar would then have the next significant resistance at 99.20s. So far, the dollar is acting very well. Let's go to the EUR. Look at that. There's the H formation failure pattern. There's the pattern we were looking at in the weekly chart. Exact opposite of the dollar. So that's all we're looking at. Now, let's do this. Looking at the, I got the dollar. I want you to look at crude oil. Let me show you something very interesting. Crude oil is holding okay in a high level short-term consolidation, but the low-level consolidation hasn't really begun. It's just a pop-up so far. And the monthly chart, just look at this monthly chart. I mean, with the world economy the way it is, I don't think that the dollar at 45 is going to hit that 57 9-period exponential moving average before it retests the low that was made recently, 38. Wow, $7 down rather than the $12 up. Yep, I think more likely 7 down rather than 12 up. That's the way I think it's going to be over the intermediate term. Most importantly, I want you to look at the TLT. I spoke about it. Look at that TLT. Look at that trend line. Look at that left side, right side price time match right there. It could have gone for another 2 sessions, but instead in 2 sessions, it held the low. It didn't break 117.62. It's making a nice reversal. That coral-colored thick moving average right there is the 200 period. It's acting as a magnet. And the MACD has not yet crossed positive, but it's headed that way. The stochastic is rallying very nicely now. So this is going to be very interesting. And that's the reason why we want to do my opening call for my subscribers this morning. We added to the short positions and don't know if it's going to work because I usually don't like to buy the gap to the downside. But sometimes, because there is so much evidence that says this time there will probably not be a rebound. And if you are long, we are long, just very specific, 2 long, I mean, not long short positions, but long positions. And those long positions are looking at the sectors that held, sector and stock that held beautifully in the last pullback. And I don't know if it's going to work, but we're taking a chance. It's holding well. Really well. One of them is holding really well. One of them is pulling back. It should be vulnerable to the market. It wasn't recently. We got a very tight stop. We'll see about that. But the short side of it is that, let me just quickly do this before we go to a break. So this is what we're looking at. A peak D in the 120-minute chart said, yes, you should be pulling back. The VIX index, this is really fascinating to me. It's up 2.84, 22.98. This is what I show my subscribers every day. It's called my overview section. And that overview section is basically saying, let me just grab this here and let me see if I can get one right here. Yeah, this overview section, which I give to subscribers every day. My first comes the Dow chart and then comes the overview. Yeah, let me just show you what I do. This is the Dow chart right here. And I do a synopsis of what we're looking at here, and then I add to it over there. And that was saying that H pattern that look with, oh, this is not updated. Oh, of course it's not updated. This is yesterday's chart. The synopsis has been that you've gone from a lowercase h, and that can go to a lowercase m, and that m can become an m with a larger arch, and that invariably, I thought it would be late today or tomorrow. I thought we'd have the chance to add to the short positions on the indexes itself, like the Dow and the S&P. We didn't get a chance because we gapped down, but that was the pattern that I said, be careful, because this is the one that tests the rectangle formation lows. So we'll look at that, and then this is the one that I sent. This is my overview section, and it has these 5 quintiles, and we'll talk about that when I get back. Basil Chapman, Target Technicians Hour. Be right back. Dow is down 251, S&P is down 29.
Today, it's hard to tell if the economy is coming or going. Regardless, I want my money going in the direction I choose. If that's your stance as well, then you want to know how Everbank can help keep your money thriving just the way you want. Is growing your money a priority? Everbank is committed to a yield pledge promise to pay high yields on your checking, money market, and CD balances. Looking to diversify? Everbank ingeniously developed accessible ways to spread your money around the world into foreign currencies and even non-FDIC insured metals. And when it comes to your wealth, they bring a highly experienced and global perspective to help you manage it. Everbank's financial philosophy flies in the face of the status quo. They believe your money's performance should not be determined by today's economic circumstances, but by the drive to rise above them and create opportunities that favor your objectives. If that excites you like it does me, visit everbank.com/TFNN to find out what they can do for you. Again, that's everbank.com/TFNN. Visit them today. Everbank is a member FDIC and equal housing lender.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN, and you'll find The Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
Tiger TV is an exciting way to experience TFNN programming. See high-definition video, giving you crystal clear charts, as well as seeing some of the faces of TFNN's highly acclaimed financial experts with crisp, full-fidelity sound. Catch Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, Larry Pesavento, Think or Swim, David White, Andy Hecht, and Daryl Martin in crystal clear, high-definition audio and video. Tiger TV, exclusively at TFNN.com. Basil takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Folks, we're back. And let me just do this because it's really important. Today's the 700th issue of Tom O'Brien's Gold Report newsletter. Last chance today to get in on a special offer of 20% off your new subscription to the Gold Report for as long as you subscribe. Details on the front page of TFNN, but you must act today to get in on this. And I mean, what an opportunity and what a nice deal. That is a terrific deal. And of course, you know, Tom is an expert in the gold, the whole metals area. He was deeply involved in it, knows it extremely well. Another thing, I just got an email. I'm just going to read it the way it is. I'm not going to do anything about abbreviating it. It says, "Hi, Basil. Chris here. Tom just cut off a caller that was spewing hate. I don't have Tom's email, so I'm asking you to pass on my thank you for pushing back against negative, vengeful talk. Thanks, you are part of a classy group, Chris in Chicago." Thank you, Chris. I do appreciate that, and I am now passing this on. And so that's, I think, yes, a classy group. And talking about a classy group, I had some emails with John Logan last night, and he's actually very lucky. He went 3 days without it being diagnosed that it was appendix. And I have to tell you, I know from having heard from many other people that a misdiagnosis of that can be fateful, and we are real thankful that he's recovering. Seems like he's doing well, but it's a process, and well, we're pleased about that. Not pleased that he got the appendicitis, but the fact that he he's on the mend, and that's really important. So this is what I'm showing you. My quintile here. This is the Dow 120-minute chart. This is the VIX index. Now look how important this is. We're in the 20s, right? This is yesterday. 20.14. Even with all the selling and the buying, the selling, the buying, the selling, buying that's been going on, we only slipped into the 17.87 area for momentarily. We're back in the 20s. That is telling you that at this particular time, you already do have insurance. Insurance is important. People are buying insurance, and it's the big guys. It's the heavy people who have a lot invested in stocks that they don't really want to get rid of. That's my thinking here, is that there are a lot of fund managers. In fact, I was with someone recently, and they've been managing money for maybe 20 years, maybe more, 25 years. And he was determined that for people who were in bonds or in more conservative stuff, even now after 6.25 years, to get you into stocks, he believed that portfolio, I think he was talking about those people in their maybe late 60s, 70s, said he doesn't know why they would be heavily that traditional 20% stocks, 80% bonds, or even 30 stocks and 50 or 70 or 60%, conservative. He says, he says, you're really, and I looked at it, I didn't say anything actually, but I my feeling is that this is a very dangerous period. This is a dangerous period because we've never been here before. And I know that it's laughable when people say we've never been here before. We haven't been here before. Not in this situation. Not when the market was doing as well as it's doing under the conditions and with jobs. This is the longest period ever that we've been. Even in the stock market crash of 1929, we had a jobs recovery. Within, I think it was between 18 months and 2 years, you start to see a big improvement. So this is different to other times. So let me go back. So the ARMS index flashed 438. You remember I was on air the other day on Friday, and I said, wow, with that, there should be a rebound soon. Well, there was that incredible rebound yesterday, incredible drop intraday. And the fact that there was buying coming into the close said to me, now we are going back to where I want to start. I even had it already in my report that we had the short Dow already that we were going to buy, etc. And of course, the futures were down huge this morning already, so we didn't get a chance for that. We did add some shorts, so that's okay. It's how you manage this. And my impression has been for a very long time that this, in a sense, is a buy and hold to the short side. We've done that in one of our positions. I wish we had done it in many more because we've had those positions, but we took profits and we got out. Small profits and small, tiny losses, not good enough. You want to be holding this because at this rate, the way that the VIX and the TRIN very often refuse to rally sharply, lately it has, but up until recently, there was just an ignoring of this market's potential downside. So I just wanted to show you this. And there are a whole bunch of other things I discuss in great detail. Larry's been showing some charts lately, and I've actually been copying them and showing some of them to subscribers. Very interesting. He's got, there's a perspective there, an historical perspective that is showing you some of the information, like how overbought we are in certain conditions. I'll be back now.
Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Techno-Mental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
TFNN is excited to offer a brand new piece of market scanning software unlike anything the industry has ever seen. John Logan and his team have spent years developing their market profile tools to finally be able to release the TAS Profile Scanner Plus. And right now, you can get a 2-week trial absolutely free just by visiting TFNN.com and providing us your name and email address. The TAS Profile Scanner Plus is the premier market profile-based scanner in the industry. Powered by the acclaimed TAS proprietary algorithms, this feature-rich scanner is a standalone desktop software that instantly filters over 2,500 global financial markets such as stocks, ETFs, commodity futures, and Forex. Within 3 minutes of signing up, you can have the software downloaded and running on your computer with a complete roadmap of market indicators and inflection points to trade off using the TAS Profile Scanner Plus. Sign up today and try this amazing piece of software by visiting TFNN.com. Larry Pesavento has just started his brand new service, Fibonacci 24/7, and he's already delivering content to his subscribers on a daily basis when the market's opened and even on weekends. Each Monday, you'll receive Larry's written report that provides detailed commentary and a summary on the charts and videos that Larry sends out. And throughout the week, when warranted, Larry will send out via charts or videos or both the key markets that he is watching during the day. This will be up-to-the-date active trading information that will help you in your daily trading. In Larry's first week alone, he sent out 25 charts, 6 videos, and a full report to his subscribers in just 1 week. If you're a technical trader that uses patterns and retracements to trade, then Larry's service Fibonacci 24/7 is something that you must try. Right now, new subscribers can get a full 30-day money-back guarantee. With nothing to risk, sign up now to Larry Pesavento's Fibonacci 24/7 by visiting the front page of TFNN.com under Trading Newsletters.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Hi, folks. So this is what I wanted to show you here because I think this is very informative. Larry, I didn't quite hear his conversation because I was in the middle of something. I actually had the sound off, but I saw the chart and I thought, oh, that's exactly the chart that I think represents what I'm looking at here in the sentiment indicators. And what did it say? It said sentiment, and this is from the AAI. This is the American AAI. Investors something or other. AAI member in question. All right, I can't remember what it is. Someone will tell me what it is. Anyway, so the sentiment shows that pessimism fell to an 8-week low. Pessimism fell to a low, ending a streak of 7 consecutive weeks with above-average readings. And in the latest survey, neutral sentiment rebounded while optimism declined and modestly. Bullish sentiment pulled back by 1.4% to 33.3. The decline keeps bullish sentiment below its historical average of 39, but it's still up there in the 30s for the 28th week, the longest such streak since the 29-week stretch in 1993. Neutral sentiment jumped 7.3% points to 37. That's important. But bearish sentiment fell 5.9 percentage points to 29.1. This is the lowest level of pessimism registered by our survey since July the 23rd, 2015. Oh, well, it's only July 23rd. It's no big deal. Well, I remember question bottom reminds us that it is more important to watch what people actually do rather than what what they say. So here it is. During the recent market pullback over the last couple of weeks, did you pull any of your money out of the market? How many people do you think said yes? 14%. How many people said no? 86%. That is the proof. And then look at that chart. That is the proof of what we've been looking at and what I've been talking about. And thank you, Larry, for showing that chart. And what we are looking at here is a situation where at this particular point, once again, in the history of the market, the so-called safety, I always say so-called safety of bonds becomes a repository for what? For the insecurity of equities. And it's doing that, but not hysterically. It's just a suggestion at this particular point. But most importantly, if you see 121 taken out, 122.30 taken out, 122.50, probably to be safe, you should look at the candle of the 4th of September. Let's call it 129.93. A close in the 122s suggests very strongly that this rally in bonds could go longer, number one. Number two is it's saying that the pressure of money coming out of stocks, and of course, because money's coming out of the healthcare, look at the healthcare, XLV, look at the XLV right now, it's down 1.1, it's down 1.5%, same as the market, so it's pulling back with the market. Look at this candle here. All I can say is that if the XLV, one of the great chart patterns, actually this, if you look at chart patterns, this historically is probably one of the most beautiful you could ever look at. If you were using this black line, the 9-period moving average, and saying the month that I close below, this is a monthly chart, from the beginning of the bull market, when it broke above the 9-period moving average, let's just take it right here in October of 2011, only last month would you have gotten out. So you were in it, let's just imagine, you were in it from June of 2012. No, that held as well. So, yep, let's call it right there because that was a decisive break. From December of 2011, let's go to the high. Let's call it $35, all the way to, let's say you got really upset and you got out at the exact low last month of 56. That is a huge gain. And if you're still holding it right now, you've got a huge gain. So this has been an incredible chart. It only touched the 9 EMA once, twice, let's see. From January of 2013, it touched it once. That missed. Twice, took it out. In fact, I think that was October of 2014, but it rallied right back. So that's twice. And then last month closed below it. That's always a hint that things are changing. And the 9-period moving average was starting to turn down. So this is very important. I had a question, could I enlarge it? Yep, I can enlarge it. This is the S&P Healthcare. And look at that. You had your Chapman wave 2-bar reversal, 77.40 on the in July, and then 77.27, 13 cents lower in August. And then you had the Chapman wave Roman candle. Oh, there are so many of these. Chapman wave Roman candle. Why? Because you know that a Roman candle blows up. Very spectacular. And when you get a Roman candle at a high, especially with a major wick like that, it suggests very strongly that if halfway into the candle there is a trading week that sees 2 or 3 days out of the week closing well below that level, that's 65.21, let's call it 65, it's trading at 68.83. Anytime in the next few weeks, in any 1 week, if you see this XLV trading below 65, be careful, because there's a real good chance that it's going to try to fill that wick, and it'll do it quickly, all the way down. It doesn't have to go to the 56.63, but go a long way down. So that's what you got to be careful of. So, and there's the H2, a very clear M pattern, lowercase m pattern. So the XLV, so money's coming out. Money's coming out of the IBB. I heard Tom talking about the IBB, great conversation, the IBB. It's trading now, this is the biotech ETF, and that had a high of 400.79 back in July. The MACD month isn't finished, and the MACD hasn't yet finished the month with a negative crossover, but the stochastic is at 80%, and it looks like it wants to go lower. Meantime, the weekly has made a peak F top in the Chapman wave. Just for disclosure, we should say that in our opening call, we are still short from the 393 area. Small positions remaining, and it's 284 it hit. And at 284, that becomes the target, especially when you've got the funds. There's just no question in my mind that the funds are just clearing out of this. You know, they went in a very slow process over a very long time. Talk about chart patterns. Here's the other one that was spectacular. Look at that. Look at how spectacular this is. Use that black line, the 9-period exponential moving average. It walked the 9 EMA ever since it broke out back in November, same as the healthcare XLV. Look at that. 102.36 was the high in November of 2011. It did not close below that 9-period moving average. It has not, even to this day, it has not closed. This is the month, so it's a September candle. So we haven't closed below it. There was a hint because we held it exactly last month. And there's a Chapman wave Roman candle. Be careful. If the IBB breaks 333 is key support. If it starts to trade under 333 for 2 or 3 sessions, close that is, under that in any particular week, it's going to impact that monthly candle. All right. So now we're getting to those nitty-gritties. Now, remember when I was talking about Ford yesterday? I said, yeah, so something's wrong with this picture. Why is it rallying when there's such... something's going on, because we know from the RTH and everything else that we're looking at, the RTH is the retail index, that there has definitely been a huge slowdown. You've seen it. It's been this arch formation that I've discussed all year, this arch formation. Let me just close this. Look at that. Here's the arch formation in the Dow, the S&P. This is this beautiful arch formation. It's just been saying something's wrong with this picture, and that we are probably... it hasn't been announced yet, but we are probably in some kind of at least a mini recession, if not a full-blown recession. And there's that arch formation. Well, you can see that in the RTH. So how come Ford, instead of being at lows or at highs, because wherever you go, you see Fords, you see General Motors products, things have changed a lot. Well, I think that what we're looking at here, it's really hard to get a grip of. I try to read reports about the auto industry. It's not difficult. The best guy that does it is the guy who does it, AN, AutoNation, whatever his name is. He's a very blunt guy, and he talks about his industry, but he is usually very optimistic. And he's obviously optimistic only because they have fabulous sales. They really do. But there's that arch formation. Something's going on. And it tells me that we've got to watch this closely. I'm coming right back to what we were talking about Ford in a moment. But look at AZO. AZO today is spiking to it's up 861. I've been waiting for this leg D in the Chapman wave, and we got leg D the other day at 917. Let me just show you what I'm looking at here. And I keep asking myself the question. I don't know who else I could ask, because it's a very complex question. I think it has to do with the low rates. It has to do with the fact that they're pushing like crazy the leases. A lot's going on. It's as I say, it's more a question of desire and economics. And if people see that you can release a car on TV for $45 or $100 with just a tiny amount down, they don't realize that every single company, no matter who it is, has to get X amount at the end. So whether they put it in the front, or they put it at the back, or they put it in the side, or they charge you for every ding, $1,000 for every ding on the car when you return. I don't care how they're going to get their money. But what's interesting is that I look around. I always look around. I've just done it since I was a kid. I've always looked at automobiles, what cars, the colors, what's in vogue. I mean, just around the way I live, it's just unbelievable how many Teslas every single day. I see 2 or 3 Teslas. I don't know what's going on, but it's going on. And not everybody can really afford it. I think people are doing it because they feel they deserve it, and their portfolios were doing it. Okay, there's something going on there. So when I look at it, I say, okay, AZO is saying to me that it's real close to having a turn down, but it hasn't done it yet. And AZO is AutoZone, one of the leading car truck part companies. And then AAP, we looked at yesterday. AAP isn't quite as strong. and it says to me that it's probably going to be the one that at least starts to fall quicker. And if you go to Orly, remember that's O'Reilly Automotive, it's got they all got different chart patterns in detail, but the complexity of their monthly is just very simple. Their monthlies are still very strong. So I'm watching this because something is going on. People are spending more on their parts, replacing parts, but at the same time, they absolutely are buying more and more cars because 17, nearly 18 million cars. Those numbers are astounding. The auto industry was groaning because it was 12 million. They were hoping to get to maybe 14. This is really incredible. So Ford is holding well. General Motors it's gone to a peak doji high and is pulling back. But from the low that was made at 24.62, it's still at 29.77. So here's the question I had in the den. Where do you think the E-mini, where the S&P is going? My answer is really quite simple. As someone in the den said the other day when I was looking at a price and I said, I don't believe it. And he said, are you telling me I shouldn't believe what my eyes are seeing? And my answer was absolutely, you've got to believe what your eyes are seeing. But it is the thinking behind the eyes that is most important. And what is the thinking here is that we made some kind of an internal low on that aberrational Monday, the 24th of August. At the same time, it tells you that these stocks have a long way to go down to do a retest from 29.75 to 24.62, 3 points. 3 points could be very quick. But in fact, most of the time, especially when you make an arch formation, there are little stops along the way, especially when you've gone with the stops along the way to the upside. It's saying there is buying, and unless something happens in the economy, and something happens in the market to really start a second day of triple-digit down move tomorrow, you might find that this makes just yet another H pattern. Just keep in mind, my thinking at least is lower lows and lower highs. And that these counter trend bounces are opportunities to short. There are a couple of situations where I would say, yes, you can go to the long side, but you've got to be very small position, and you've got to be prepared that that long side could be taken out the same day you put it in. Okay? That's the way it is. So as I'm looking at this, I'm saying, I think we're getting a lot of clues as to what's going on. And one of the major clues is, have a look at this. This feels like just a horrible day. I mean, down almost 300 points, down 33 in the S&P. Look at this. The VIX is only trading at 23.26, up 15%. It's a big percentage. But look at the chart formation. It's just stuck in this little block over here. It hasn't broken the high of 2 days ago. Was that Friday? Yep, on Friday. It didn't go above 23.99. Day's young, it could still do that. But look at it. Isn't that interesting? I find that fascinating, that there's a kind of a disbelief in this move down, or a hope. I think it's more a hope that we don't go back to that 50% decline type market that we had before. And that, in fact, the bull market is continuing, and that this is just a mere bump in the road, and that most of you will turn around and be able to say in 3 months' time, thank goodness I didn't do anything with my portfolio. Every other time I sold, this time I held it, and things are fantastic. Actually, what might happen is it won't work that way. That when you look around, you might find that actually taking a little money off has been the prudent thing to do, to get enough equity to be able to buy some of these there'll be great bargains coming up. That's the way you're going to look at it. Like you're going to the supermarket and you're looking for the sales of the stuff you always eat. I'll be back. Basil Chapman. Oh, big rally. Now it's only down 259.
Until recently, it was almost impossible for the average investor to hedge against currency risk in Europe or Japan. For a bold trade on Europe or Japan that protects against moves in currency, trade HEGE or HEGJ, 2 times currency hedged leveraged ETFs from Direction Investments. Visit directioninvestments.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 866-476-7523. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foreside Fund Services, LLC.
Hi, I'm Steve Rhodes, host of the Trader's Edge, heard daily at TFNN.com and author of Mastering Probability, a daily investment and trading newsletter service that I send out each morning by 8 a.m. My morning newsletter service covers exactly what the markets have been doing since last night's close, providing you with an edge on your trading day ahead. You get actionable trading ideas, including the exact entry, stop, and profit targets. Plus, I'll teach you the patterns and hidden market correlations that will make you a better trader. As a subscriber, you'll gain access to my 90-minute money management workshop, where I'll teach you the secrets that'll save your assets. The bottom line, I've got your back, including a 30-day money-back guarantee. See for yourself the type of analysis I provide each trading day by signing up for Mastering Probability today. With nothing to lose, this is an offer you should not pass on. Mastering Probability can be found under Trading Newsletters on the front page of TFNN.com.
In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors. TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Hi, folks. We're back. And let's see. I just want real quickly, because I know that many of you are actually trading during the day. I had circled this yellow circle right there, suggesting that there should be a rally for the 923, 922 area, and it should take you to the 927, maybe the 930-ish area if there was a left side, right side price time match, and that should come in between 12:20. It should start real soon. You should see it much better at 12:10, and maybe at 12:20 that'll be the target. If that fails to take place, and in fact from now until 135, 140, instead of a brief rally to test internal strength, there's a pullback, and that pullback takes you to Dow minus 300, and the S&P will be about minus 36 or so. That's going to say, this time we're not coming back. This time we're going to be staying down. And this is going to be a very interesting session. So I got an email from another Chris. It's funny how two of you Chris's are from different places, and very often on the same day you ask me questions. Sometimes they refer to the same thing. Please comment on details of residual. Hi, Basil. Please comment on details of residual low, internal low as you see it. Is there a forecast for a retest of the August 24th low? Because the next 2 to 3 2/3 daily candles tested the wick. Two, three candles tested the wick of the 24th. Please let me know if I'm understanding correctly. Also, when are we waiting for this residual low? How close to the internal low does the test happen? I.e., are we essentially looking for a double bottom at the wick bottom? Where can I read up on this? As you're the first person I have heard use this terminology, and many professional traders were not expecting an August low retest until very recently. Thanks, Chris. Chris, and I don't know if you'll read it anywhere, but it's something that I was discussing back in 1984. And I was discussing for clients how there are times where there is a low that is made in the market with extremely high readings, sentiment readings, and technicals are very poor, etc. And then I'd noticed it takes like 6 weeks to 8 weeks, and then you get another sharp sell-off. That sell-off can go toward that low, it could hit that low exactly, or it could plunge right underneath it. But when that happens, the technicals are not nearly as bad. The sectors, you've started to see improvements in the sectors, and the volatility index doesn't go anywhere close to what it was on that original pullback. I think I showed that for my subscribers in the VIX. Yes, I did. For the VIX index, you remember that chart that I showed you? Monthly chart where I showed the high of October of 2002 was the VIX was way higher than it was in 2003 in March. The Dow and the S&P didn't coincide. One of them did not retest the October low. One of them did. Same as the semiconductors. Semiconductors did not retest. So sometimes that's the internal. That was months. That was 6 months later. So I'm looking at this and I'm saying, okay, 6.25 years on the upside. You're surely not going to, it's either going to be priced with a crash, which I don't think we're in for. I think it's lower highs, lower lows. The result might be the same for the stocks in price, but the speed is not there because crashes happen with a August the 17th or 22nd of 1987, and you had a 500-point move down, and then you got the 500-point move on October the 19th. There are basically two moves. There's a big arch formation with a retest of lowercase h and a smash to the downside. That's a very different pattern. So let me just answer the question by saying, I believe from the evidence that I see, it's going to take time, and that I do believe that for most of the indexes, the August low will be tested, but it's going to be even now, look at the chart as we're closing. And folks, have a great, great day. And let me show you something. Look at this.
This coming Tuesday, September 22nd, Tom O'Brien will publish the 700th issue of his weekly newsletter, The Gold Report. It's amazing to think that Tom started his newsletter over 13 years ago when gold was trading under $300 an ounce. To celebrate the 700th issue, you can sign up right now at a 20% savings off the regular monthly price, and you can lock in that low rate for as long as you remain a subscriber. The Gold Report is Tom's weekly newsletter covering the gold market as well as a variety of gold mining equities. The Gold Report is published every Tuesday afternoon with a market update sent out to subscribers on Monday mornings. Tom will walk you through what's going on in the gold and metals market each week, as well as providing specific buy and sell recommendation on the mining equities themselves. Now is the perfect time to sign up for the Gold Report. The 700th issue is published Tuesday, and that's when this sale ends, so act now.
This is TFNN.